Good morning, Bitcoiners, and welcome back to your economic calendar with the news and analysis you need to start the week off right in Bitcoin. As always, I'm your host, Mauricio Di Bartolomeo here at Ledn, and today is Tuesday, December the 6th. Today, we're going to be looking at a new trend that we're seeing emerge in markets during this crypto winter, and that is a change in what investors are buying and holding in these conditions. So we're going to dive into that. We're also going to go over last week's headlines and give an update on what has been happening with the Genesis Capital situation. And we're also going to take a fast forward look into the following week, which will be a big one when we get another read at US inflation. And that'll be followed quickly by another Fed meeting and interest rate decision. But for now, let's dive into this week's and go right into it. And starting as we usually do with Bitcoin, let's take a quick look at last week's price action. And we see that Bitcoin last week closed up by 4.2%, closing just north of the $17,000 mark. And we see that so far this week, it is continuing to trade north of that $17,000 mark. Now, let's take a quick look at what's been different so far this bear market. Now, before we get into that, as you can see here, Bitcoin is down by approximately 63% year to date, and Ethereum is down by roughly 67% year to date. Other crypto assets have experienced even more severe losses, as many know. And historically, whenever crypto markets crashed, like in 2018 and 2020, Bitcoin's share of the total crypto market cap would increase. This was seen as the flight to safety effect equivalent for crypto. And the flight to safety effect in traditional markets is when investors flock to the safest and most liquid asset during times of uncertainty. In traditional finance, that is referred to as the US dollar. And in crypto terms, that was often referred to as Bitcoin. Now, let's take a look at historically what has happened in the past when markets crash, just so you can see this example. And now what we have here on the orange line is called the Bitcoin dominance. So it's the percentage of Bitcoin's market cap relative to the entire crypto market cap. And as you can see here from the crash in 2018, what we saw previous cycles was that when the prices of Bitcoin started dropping, the dominance of Bitcoin relative to the crypto market share would rise. And we saw this in 2018, and we saw this again in 2020, where when it crashed, it remained pretty high. And as markets started rallying is when we started seeing that dominance come down. Now, as you can see from the chart on your screen, this bear market has been different because we are seeing basically Bitcoin and all crypto assets sell off quite significantly, but we're seeing that Bitcoin dominance is effectively flatlining here relative to other previous cycles. And now that begs the question, what are investors holding in this environment? And the answer to that question is stablecoins. Now, the chart on your screen is the total supply of USDC stablecoin and Tether USDT stablecoin only on the Ethereum chain, but it's still pretty representative data. So what we can see here is that at the start of the year, the circulating supply of Tether and USDC stablecoins on Ethereum was a combined $77.83 billion. So you can see this basically from the 1st of January in this chart. And today, that same stablecoin supply of these two assets, it's a combined 72.38 billion. So that represents a mere 7% drop for the year. What this means is that even as the total market capitalization of crypto assets has fallen by more than 60% from 2 trillion at the start of the year to now around 815 billion, the total supply of stablecoins in these two on the Ethereum chain has remained north of 70 billion. This in turn has increased the percentage share of stablecoins relative to the total market capitalization of crypto assets. Let's take a quick look at another chart that highlights this. Now, the chart on your screen compares the relative market capitalization of Bitcoin, Ethereum, USDC, and USDT versus the market capitalization of all crypto assets. And this is otherwise defined as the dominance of each one of these assets relative to the total crypto asset pie. So as you can see here, the purple line is the USDC dominance. The blue line here, the light blue line, is USDT dominance, which is Tether. The yellow line is Bitcoin dominance. The orange line is Ethereum dominance. And this down here is just the price of Bitcoin during that same time frame. And the chart speaks for itself. As is evident from here and from the data, stablecoins represent an increasingly growing slice of the total crypto asset pie. Now, what may confuse some North American and European investors is the question, but why hold stablecoins when I can just hold dollars in my bank and put them into a money market fund? The answer is most people around the world can't freely hold US dollars in a place or format that they can trust, nor do they have access to US Treasury bonds. They do not trust their local banks, and saving in US dollar cash can be a liability in developing markets. If cash dollars can be easily seized, and there's also a big risk of fraud and fake bills when you are exchanging doing these types of transactions. Also to note, US dollars in cash are not very useful these days as they cannot be used to pay for anything online. It can also not be deposited to any local entity to transact or earn interest. The benefits of stablecoins to the developing world are clear as water. Stablecoins can be used in platforms like Ledn to earn interest or receive loan disbursements. Stablecoins can be easily converted to US dollars or local currency. They are not as volatile as Bitcoin, and there are increasingly options to pay online with these stablecoins. Now, over time, clients will be able to pay with stablecoins effectively anywhere where a credit card is accepted. Now, the downside to stablecoins, which is complexity of use and transaction fees, will likely get eroded away or abstracted away in a short period of time. This is a trend that we expect to continue as the world, thirsty for dollars, continues to learn about stablecoins. Now, in parallel, companies will continue working on making stablecoins more accessible to the masses. Both of these trends will converge in a Cambrian explosion of solutions that will benefit the developing world in particular. Sticking with stablecoins, let's just move over to the headline here. Circle, the operator behind USDC, announced yesterday that it was canceling its plans to list on the US stock market through a proposed SPAC transaction. This is the headline on your screen that makes reference to this. The announcement makes sense given current market conditions. In simple terms, a SPAC listing is a process whereby a private company that does not trade in the public markets merges with a shell company that does trade in the public markets but has no running business. It's a process that makes sense when a company, in a particular hot sector like crypto was last year, wants to capitalize on investor interest and good market conditions like we had last year in the stock market. For context, Circle announced its plans to list via a SPAC in May of last year, when conditions were much better in both crypto markets and capital markets. Right now, both of those markets are under a lot of pressure. And in the current market context, it makes little sense for Circle, or anyone for that matter, to list via a SPAC. Switching gears briefly here, another piece of news that generally flew under the radar last week was the fact that Genesis Capital is now negotiating with two of its creditors that total $1.8 billion in claims. And this is, again, the headline that makes reference to it. While this is not surprising, the news highlights that pressure continues to build on the Genesis team to come up with a solution for its creditors. Now, as we mentioned in last week's dispatch, any resolution on the Genesis Capital case will move markets regardless of the outcome. A positive outcome, i.e. a debt restructuring and reopening withdrawals, would be favorable for crypto prices, and vice versa, a negative outcome would put additional selling pressure in both Bitcoin and crypto assets in general. So keep an eye out for that headline in the coming weeks. Now, as always, we wrap up with what's ahead for the week. This week will again be relatively light in terms of data and events, as Fed officials are not giving out speeches this week because they are preparing for next week's FOMC meeting, where they will announce another interest rate decision. Prior to that Fed meeting, we also are going to get a new inflation reading for the United States on Tuesday. And again, the interest rate decision for next week for the Fed will happen on Wednesday. We'll have that all in next week's back again. But that is effectively why there are no Fed speeches this week. And otherwise, it is a relatively light week in terms of data. But here is a quick summary of what we can expect for the week ahead, which is Friday at 8:30 a.m. Eastern, we're going to get the producer price index out of the US. Remember, the producer price index is seen by some as a leading indicator to potential consumer price index, which is what everybody's fixated on right now, and what we're going to get data for next week ahead of the Fed decision. So with that, we wrap up this week's episode. If you enjoyed it, if you learned something, I welcome you to like it, subscribe to our channel, and share it with your friends. And as always, if you haven't checked us out, do so at ledn.io. And please let us know what you think in the comments if you have any questions for next week's issue. Thank you once again, everybody. Los quiero mucho, and see you next week.